Okay, thank you for joining me for our second class period of the week that I am gone, week 3. We are going to start chapter 3 and just talk about the concepts that we are going to cover and just go through the PowerPoint, and I'll probably go through about 30 minutes worth of PowerPoint just to introduce the topic, and then both Wednesday and Friday of the following week, we will still be working in Chapter 3, finishing out the accounting cycle, going all the way through the end of the period. So we'll just jump in and get started. We're going to talk about something called accrual-basis accounting, and so let's introduce that. It has to do with understanding when and how revenues and expenses are recorded. Let me actually put this into a nicer looking format. There we go. So let's understand when revenues and expenses are recorded. And you might be saying, hey, why don't we just record revenues and expenses at the time that we have a revenue or expense? And that seems logical in one sense, but in accounting, we want to understand how the money flows relative to how our business operates. So if we have sales in December, we want those sales to show up in December, and we want the expenses that coordinate with those sales to also show up in December. So this is called the revenue recognition principle. Revenues are recorded in the period in which the goods or services are provided to the customers. In conjunction with that, we have the matching principle for expense recognition. Expenses are reported in the same period as the revenues they help to generate. So the key point, the revenue recognition principle states that we record revenue in the period in which we provide goods and services to customers, not necessarily in the period in which we receive cash. So we have revenue for a cruise line, and people have paid in advance for the cruise. We're looking at the revenue on the bottom. But the cruise takes place mid-April. So people have probably booked months in advance, so they've sent in money around January. However, we are not providing the cruise service until April. So we actually want to recognize the revenue that we've received in April. Recognize it on the income statement. Now we are going to do the accounting transactions right away when we receive the cash. We will recognize the cash, and so we have cash in, but we have deferred revenue on our balance sheet, that liability. People have paid us cash, but we owe them a cruise. And so back in January, when people paid for the cruise, we had an accounting transaction of an increase in cash, which is an asset, and an increase in our liability of deferred revenue. And then in April, we now want to recognize on our income statement that revenue, because now we are providing the good and service. So we are going to have what is called an adjusting entry. We have accrued the money on our balance sheet and held it there, And now in April, we are going to recognize on our income statement through an accrual transaction. So that's what we're covering in Chapter 3. And so it's the same with expenses. We're going to have to get ready for this trip. We're going to have to buy supplies and fuel. We're going to have to pay people typically after the fact. We typically don't pay employees in advance of their work because they may not show up at that point. But we'll pay them after their work. But if the timing works out that, okay, we went on the cruise in mid-April, but we don't actually cut a check for employee salaries until May, I want to accrue those expenses in April to match with my revenue instead of in May, because when I look back at my financial statements monthly, I might say, why do I have so much revenue in April, but low expense, but high expense in May, and not as much revenue? So we want to match those expenses with the revenues. If you hear clicking sounds in the background, that is my dog, Luca. Luca, stop. And he is enamored with the cat, and so he keeps following her and walking around. So that's the clicking noise if you hear clicking in the background. So the key point, most expenses are recorded in the same period as the revenues they help to generate. Other expenses indirectly related to producing revenues are recorded in the period they occur. So which statement best describes when expenses should be recorded? Expenses are recorded when paid. Expenses are recorded the day a company promises to pay, or expenses are recorded when the cost is used to help produce revenue. And of course the answer is C. We try to match, we use the matching principle in conjunction with the revenue recognition principle. So that in a nutshell is accrual-basis accounting. There is cash-basis accounting where you do just recognize revenue and expense as it comes in. So we don't accrue things to match. Let's look at examples. So accrual basis, when we receive revenue, we recognize it when the goods and services are provided to customers. So if someone prepays, in the case of the Eagle Golf Academy, remember in Chapter 2, we had people paying ahead for golf lessons. So maybe they wanted 6 months of lessons and they paid upfront in advance. We are only going to recognize the revenue for each lesson as it occurs. So if that customer is taking 2 lessons per month at a price of $200, $100 each lesson, so $200 total, then we only recognize $200 in the month in which we provide the lessons, and we have accrued the rest of the revenue on our balance sheet. Cash basis, we just recognize that revenue when it comes in. If they pay 6 months in advance, 2 lessons per month at $100 per lesson, that's 12 lessons for $1,200. They paid that in April. Then we just show revenue of $1,200 in April and nothing for that customer the rest of the months. Expense recognition. In accrual basis, we recognize the expense in the period costs are used to help produce the revenues. For instance, when we pay the golf instructor, even though our customer paid us upfront for all the lessons, we're probably not going to pay the golf instructor until he or she has provided the lessons. so we will recognize that expense in the period in which it occurs. But sometimes timing doesn't match up, and if my customer has 2 lessons in April, but the second lesson is at the end of the month, so my employee has done the work, but I have not had a chance to pay them yet, I'm going to accrue that expense for April, even though they're not getting paid until May, because I want to show that expense matching up with the revenue. The accrual basis is part of GAAP, Generally Accepted Accounting Principles. And GAAP, remember, governs corporations. And most accounting, even at small companies that are not covered by GAAP, also participate and heed GAAP standards. So most companies try to do accrual basis accounting instead of cash basis. It really just helps with looking at your financial statements and understanding how your revenue and expenses work throughout the year. So we'll look at some examples. So we provide golf training to customers for cash to the tune of $4,300. So the service is provided and the revenue is recorded in the same period for both accrual and cash basis. They pay us and we provide the good service in the same period. So we recognize the revenue. What if we provide golf training to customers on account for $2,000? So we give them the lesson and then we send them a bill and they owe us $2,000. In accrual basis accounting, we record that revenue in December because we have provided the service. That dollar amount is an account receivable on our assets now because we are going to be receiving money from someone. But on cash basis, we do not record revenue. It's like nothing has happened until we actually receive the cash. What if we receive cash in advance for 12 golf training sessions to be given in the future? $600. So they've paid us up front, like we talked about. We are not going to recognize the revenue under the accrual basis until we provide the service. But under cash basis, we record all $600 in advance. Now here are some expenses. We pay for 1 year of rent in advance, $6,000. That's $500 per month. Under the accrual basis, we don't record anything yet, and then at the end of the month we'll make an adjusting entry of $500 to recognize that $500 expense. But in cash basis, in the month of December, we record all $6,000 at one time. We can purchase supplies on account for $2,300. So we have received the supplies, but we have not paid them yet. And we have not used them yet. For accrual basis, we can buy a bunch of supplies up front, but then only record an expense for what has been used during the period. So during the month of December, even though we purchase $2,300 worth of supplies, we may have bought ahead quite a bit. So at the end of December, we may discover that we've used $300 worth of supplies. So we will record an adjusting entry at that point for the month of December for $300. In cash basis, we have not paid anything yet because we've paid on account, so we don't record anything in December. And then probably the money will get paid in January, and that's when we'll record the entire $2,300. Now we pay salaries to employees of $2,800. They did the work, they got paid all in the same period, so for both methods, we record the expense. So the difference between the two is timing. Under accrual-basis accounting, we record revenues when we provide goods and services to customers, and we record expenses with the revenue they help to generate. Under cash-basis accounting, we record revenues when we receive cash, and we record expenses when we pay cash. Cash-basis accounting is not allowed for financial reporting purposes for most major companies. Which of the following would be recorded as an expense under accrual-basis accounting? So go ahead and read through our options. Try to get an answer in mind. The company uses utilities in the current period but does not pay cash. A cost is used to help produce revenue. So we've used those utilities to keep the lights on, to run the heat in Michigan in the winter. That's a necessary expense. And I can't conduct business without those utilities. So I'm going to record that expense in the month in which I use them under utilities expense. Which of the following would be recorded as an expense under cash basis accounting? Just have a read and see what you think. A cash basis expense is recorded when cash is paid for a cost of running the business. The company paid cash for supplies and would therefore record supplies expense under cash basis accounting. So let's look at the measurement process. So now we are making adjusting entries. These are just more transactions that we are recording. So throughout the month, we have conducted business, we've recorded several transactions, and then we get to the end of the month and we discover we have some adjustments and accruals to make. So we're going to add those entries onto our list of transactions. So during the year, we record and post those external transactions that we did in Chapter 2. And at the end of the year or at the end of the month, whatever period you're adjusting for, we record and post adjusting entries. Once we have adjusted everything, then we can go ahead and prepare our financial statements. And then we record and post closing entries, which we will not get to today, but we will talk about on next week. So, types of adjusting entries. So we need adjusting entries because some transactions have occurred during the period but have not been recorded by the end of the period. These often include activities that occur daily, like using supplies, earning interest, and rent expiring, meaning we've used a particular amount of prepaid rent if we prepaid. So we have 4 types of adjusting entries. we've got prepaid expenses, where we pay cash, or have an obligation to pay cash, but just say we pay cash, to purchase an asset in the current period that will be recorded as an expense in a future period. Think prepaid rent. We paid $6,000 up front for 12 months of lease, and we will record $500 worth of rent expense in each of our 12 monthly periods, so that at the end of the year we have $6,000 worth of rent expense, but we are showing it per period by the amount that we've used. In 1 month, we use 1 month's worth of rent. Deferred revenues, we receive cash in the current period that will be recorded as a revenue in a future period. And we've talked about that a few times. And then accruals, we've got accrued expenses, where we record an expense in the current period that will be paid in cash in a future period. So we use utilities today, but I don't get the bill until next month, but I want to show the expense of utilities used in my current period to match up with the revenue that it helped generate. Accrued revenues, we record a revenue in the current period that will be collected in cash in a future period. So I'm providing the service or product today, but the customer is paying on account, so I'll receive cash in the future, but I want to record my revenue today. So we are going to end up going through all of these transactions when we get back together on Wednesday. Well, how long do we have? Okay, let's go through a few together for a few minutes. I just don't want to do an hour's worth of video right now, but I think we can do a little bit more. So let's get through a few transactions. Oh, whatever, we'll just keep going. Okay, so we've got prepaid expenses. Prepaid expenses are the costs of assets acquired in one period that will be recorded as an expense in a future period. These costs are initially recorded as assets because they provide future benefits. We expense these costs in future periods as the assets are used. To do that, we have to make an adjusting entry where we debit an expense account and credit an asset account. So in our original entry, when we recorded the prepaid expense back in January, say, we prepaid rent, so we debited our prepaid rent account because that's an asset, and that increased our asset of prepaid rent, and we credited cash because we did actually pay cash at that point, and we reduced cash, and cash is an asset, and assets are reduced by credits. Now, at the end of one period, once we've used 1 month's worth of rent, we want to record that expense. Now we'll make an adjusting entry. Now we're going to debit an expense account, rent expense, and credit the original asset account of prepaid rent. So now we reduce the balance in prepaid rent, and we've recorded an expense of rent expense. So let's just look at that visually. Cash paid for rent in advance, record prepaid rent. By the end of the year, some prepaid rent expires. So we paid $6,000 up front, but that's for the year. During the month of December, we have used $500 worth of rent. So once we've recorded that expense, we have $5,500 remaining in prepaid rent. Here's what the entry looks like. Debit to rent expense, credit to prepaid rent. In Chapter 2, we booked the original entry as a debit to prepaid rent of $6,000 and a credit to cash of $6,000. So with this adjusting entry, cash is not touched at all. We've already paid the cash. We're not worried about the cash anymore. We're just focused on recording the expense that was used. We'll do this last one, then we'll call that a good start. Prepaid expense, supplies, cash paid for supplies. We recorded that. By the end of the year, some supplies are used. We re-inventory those supplies and figure out of the total $2,300 in supplies that we originally bought, we have $1,300 remaining, which means we used a value of $1,000 to conduct our business. So remember back in Chapter 2, we made the journal entry, the original journal entry, of a debit to supplies, our asset account, to increase supplies. We made a debit of $2,300 and a credit to cash because at the time we paid cash of $2,300. Now we realize we've actually used $1,000, so we need to record this expense. So we debit our expense account for $1,000 and credit, thereby reducing our supplies account by $1,000. So our supplies account on the balance sheet will have an ending balance of $1,300. And let's call that good for now. And we'll get into the rest when I return. I threw a quick little quiz out there just to cover this material. Under week 3, it's just a few questions. Make sure you complete that and complete it before class on Wednesday of week 4, which is January 29th. So be sure to do the little quiz that will be plugged in here once I get my file in there. Complete that little quiz before January 29th so that you get credit for actually having watched this video. Thank you very much, and I look forward to seeing you soon.